So when the public wakes up to the real inflation threat, and when they realize that they've been sold a bill of goods with Bitcoin and other cryptos, they're going to be looking for gold and silver. And there's not a lot of it, the supply, especially with the central banks buying gold, but there's not a lot of silver out there. So I expect prices to go much, much higher when the Americans and the Europeans wake up to reality. And the reality they're going to wake up to is stagflation, and that, inflation is here to stay. Inflation is not going anywhere. The central banks spent over a decade deliberately creating inflation as a policy choice. That was their goal.
As we present clips from the interview, please like this video, subscribe to the channel, and turn on post notifications for more videos like this. We appreciate the support and hope you enjoy the video. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
Essentially, if the tariffs are applied to gold, they might be, and if they're implied, no matter where we import it. Now, the U.S. also produces gold, so we have gold that we produce ourselves. Obviously, that wouldn't be subject to the tariffs. But obviously, if demand for physical gold increases and it's beyond the ability of the U.S. domestically to supply that demand, then gold is going to get more expensive if you got to pay a tariff to get it. And that would also probably open up, depending on how high the tariff was, that people might start smuggling gold in and selling it that way, because the black market price for gold would be a lot lower than the legal price, which would include the embedded tariff. Yeah, so that could be a reason, but that would be, the companies that want to sell that want to get it in before there's a tariff. Of course, you could also buy gold and keep it stored offshore and never take delivery of it, in which case it wouldn't be subject to the tariff. So there's nothing that would stop Americans from buying gold and having it delivered to a vault in Switzerland or Singapore, and then you wouldn't pay the tariff. You'd only pay the tariff if you brought it in. But of course, you could, try to bring it in, secretly in your pocket or something, and not, if you maybe bring it in less than $10,000 worth at a time, if you make a lot of trips, and then, you don't pay any taxes on it. And even people that brought in more than $10,000 worth, they could take a chance that nobody stops them. But
do you think that there's a better explanation for that delay and that demand for gold from the LBMA then?
It may be that the people who have bought a lot of futures contracts want the gold. Maybe they bought the futures contracts with the intention of taking delivery because they want to keep it. And they thought, hey, I'll buy these gold futures contracts and then take delivery, because they're not speculators. They actually, want to own this gold. And maybe it was less disruptive to the markets to just go into the futures markets than try to buy it on the spot market. So who knows? We'll find out what's going on with that. But, as far as our tariffs, like if we had tariffs on gold, see, it's not going to impact Canada. I'd say we buy a lot of gold from Canada. If we have tariffs, so Canada will sell that gold, to China or somebody else. It's very easy to ship gold, right? Go put it on a plane and go anywhere, right? It's a little bit different, when you're talking about oil, natural gas, electricity, where it's a lot easier for Canada to sell it to the United States than it is to sell it to China. But gold, if Americans don't buy it, somebody will. Very easy. Gold is pretty fungible. Obviously, yeah, gold could come in. If we said we're not going to take any gold from country X, well, country Y could buy that gold and just resell it to us. And if they had to melt down and recast it in their own, mint branding, they could do it very easily.
Yeah.
That already happens right now. A lot of the goods, you put a tariff on Chinese goods, but you don't put a tariff on Indonesian goods. Indonesia just buys a bunch of stuff from China and then resells it to us as if it was made in Indonesia.
Just right? Like Russian energy.
Yeah. Now it's going to increase the cost somewhat. Let's say there's a 25% tariff on Chinese goods. And so they end up selling the goods to Indonesia, and they just change the labels on the garments or whatever the hell it is. and they sell it to us, maybe we end up paying 10% more instead of 20% more, right? So Americans pay more, and the government doesn't collect any tariffs, right? Because they got no tariffs because we didn't buy it from China. We bought it from Indonesia, but we paid more money for it because it was cheaper when we bought it for. So everybody loses except Indonesia. They win. Usually this stuff doesn't work. I mean, and then if we go into the trade war, everybody loses. We all benefit from free trade. And the less free trade is, the more of those benefits we lose.
Well, there was also
the government has to raise revenue. See, you could say, well, is a tariff a better way to raise revenue than an income tax? And I would say yes, because income taxes harm the economy too. I mean, there's no way the government can take money away from the economy without doing harm. Now, you can argue that, well, when they put the money back in, there's some gain, right? And you could debate how much. I mean, I think there's very little that the government does that's actually a benefit. Most of it is a net negative. But we have to pay for government, right? Once we decide we're going to fund government, we got to cover the cost. And I believe that tariffs do less damage than the income tax. So if given the choice, I would rather pay with tariffs. Now, the problem is the government is now so big, you can't run it on tariffs. But 150 years ago, yeah, no problem, because the government was tiny. It hardly did anything, which was a good thing. And you can pay for it. But now the government is so enormous that tariffs alone won't do it, right? You need an income tax. You need a Social Security tax. You need all these taxes if you're going to have all this government. Now, I'd rather get rid of the government, and then we can get rid of a lot of the taxes.
About a week ago, China's National Financial Regulatory Administration, NEFRA, initiated a pilot program permitting 10 major insurance companies, including industry leaders like PICC Property and Casualty and China Life Insurance, to invest in gold. This marks a significant policy shift, as it's the first time Chinese insurers are authorized to include gold in their investment portfolios. The program aims to diversify insurance fund utilization, optimize asset allocation structures, and enhance asset liability management capabilities within the insurance sector. Under this initiative, participating insurers can allocate up to 1% of their assets to gold investments. Analysts estimate that it could inject up to 200 billion Chinese yuan, approximately $27.4 billion, into the gold market, potentially driving up prices. This development comes at a time when gold prices have already been on an upward trajectory, with a surge of about 40% since late 2023, influenced by economic and geopolitical uncertainties. The increased demand from Chinese insurers is likely to further bolster gold prices as the market adjusts to this new source of substantial investment. Peter Schiff discusses what this means for gold prices amidst increasing geopolitical tensions and global economic uncertainties. Let's get back to the video.
We've also had the recent announcement of Chinese insurers being allowed to invest in gold. Is that going to be a new big source of demand going forward here?
I think it'll be a source. I think that if they were legally prevented from owning gold, gold's been a very good performing asset. It's actually beaten the stock market over the past 25 years or so. It's up 10x. The Dow's not up 10x over that time period. So, it's done well. And so I think it's a good portfolio insurance. It's something that I think if you add it to your portfolio, it reduces the overall risk of the portfolio. So I think these insurance companies would probably want to have some gold in their portfolio. So sure, I think, they're, as a new buyer, it will, obviously at the margin impact the price. I don't know how much they're going to buy, but I do believe that over time, a lot of institutions that are not buying gold will start buying it. I mean, the reason that gold has gone up is because central banks have been buying. The public has been selling, especially in the US and Western Europe. Maybe in China and India, they're probably still buying. But Americans are selling their gold. We had net outflows all year last year in GLD. We had net outflows in all the gold ETFs, GDX, GDXJ. We've had a pickup in net outflows of, not outflows, but redemption sales at Schiff Gold. We're getting a lot more people than we used to calling up and selling us their gold. Hey, gold's $2,900. Hey, let me sell some. I can use the money. We're not getting a big increase in people saying, "Oh my God, gold's 2,900. Let me buy it before it goes even higher." Right? We're not getting the, "Oh my God, I got to buy. I'm afraid to miss out on more gains. I better sell while I can before the price goes down." So we don't have any kind of speculative fever surrounding gold mining stocks. It's the opposite. So it's the central banks that have been buying. That's one of the reasons that the gold silver ratio, I think, is 90-1, because the central banks don't buy silver. They don't have the room to store it. I mean, that's not what they want. They want gold. It's generally the public that buys silver. And so when the public wakes up to the real inflation threat, and when they realize that they've been sold a bill of goods with Bitcoin and other cryptos, they're going to be looking for gold and silver. And there's not a lot of it. The supply, especially with the central banks buying gold, but there's not a lot of silver out there. So I expect prices to go much, much higher when the Americans and the Europeans wake up to reality. And the reality they're going to wake up to is stagflation, and that, inflation is here to stay. Inflation is not going anywhere. The central banks spent over a decade deliberately creating inflation as a policy choice. That was their goal. Quantitative easing is just a euphemism for inflation. They said, we need higher inflation, and we're going to print more money. We're going to let governments go deeper into debt. And I kept saying, you be careful what you wish for, because you're going to get a lot more inflation than you bargained for. And there's no way you're going to be able to stop it, right? You're not going to be able to turn the spigot off. And so that's where we are. This is going to be the most inflationary period of time that the United States, Europe, Japan have ever seen. It's going to be way worse than the 1970s, because we were in a position in 1980 to put the brakes on inflation, because we had Ronald Reagan, we had Paul Volcker, we jacked interest rates up to 20%. 20%. Now, the highest inflation ever got on the CPI was 13, yet we had 20% raise. So this cycle, we had inflation go to 9, and the highest we got was 5.25. Clearly not enough, right? So we didn't do what they did, and they brought about the worst recession since the Great Depression in the early 1980s. But when they did this, when they went on this inflation fight, debt to GDP was 30%, not 120%. The average maturity on the national debt was probably at least 20 years, not 4 years. The U.S. was still the world's biggest creditor nation, not the biggest debtor. We were still running trade surpluses in 1980, not massive trade deficits. So we are not in a position to survive the inflation fight the way we did in 1980. So we were in a position, and we had the ability to end it. And the stock market in 1980, the Dow was 7-8 times earnings. I think the dividend yield maybe was 6% or something. I mean, the stock market was cheap. The Dow was under 1,000. The price of gold was 1,000. I mean, the gold and the Dow were the same price, right? I mean, talk about cheap, right? I mean, it was as cheap as stocks were at the bottom of 1932, after the market crash. So we had cheap stocks. We had, interest rates were 13% on a 10-year treasury. So we were in the opposite position that we're in today. We have no ability to wage a winning war against inflation. That's why we surrendered already. That's why the Fed started cutting, because 5.25 was too much to bear. So the inflation is not going to end. It's just going to get worse and worse and worse. The only thing that could save us, I guess, would be AI and a massive productivity boom that could eventually bail us out.